Welcome to this PowerPoint presentation of Shoebox Accounting, presented by the Small Business Development Center and Columbia Gorge Community College. The purpose of this presentation is to help further explain some basic accounting terms and concepts so you can have a better understanding of how financial transactions are tracked within a business. While it is my hope that you will use a more sophisticated means of accounting within your business than a shoebox, the concepts will apply to any accounting system you use. All accounting is based on the double-entry accounting system in which every transaction has a debit and credit. Debit and credit entries must be equal or else your books will not balance. We will see this specifically later in the course when we look at the balance sheet. One way to illustrate the nature of the double-entry accounting system is to look at the T account. Here you can see how this structure illustrates that each account type can be affected by either a credit or debit entry. Here are some more examples of the T account structure. Here you see how each account type can be individually tracked and balanced each time a financial transaction takes place. Let's take a look at some basic accounting definitions. Assets are things of value that your company owns. This could be items such as cash, a building, or your accounts receivable. The opposite of this is liabilities, which are obligations of the company. Examples of liabilities could include accounts payable, long-term debt, or a short-term loan. The difference between assets and liabilities is equity. The basic accounting equation represents how these terms we just went over are related. I often find that when looking at these accounting terms, it helps to not only think of examples of each type in the business world, but to also look at some examples from our personal lives as well. For example, let's consider an asset like a house. Your home has a value, and to keep it simple, let's say your home is worth $100,000. Now, you may have a liability associated with this home in the form of a mortgage. Let's say your mortgage balance is $50,000. This would leave you $50,000 of equity in your home. As you can see from the accounting equation that this example balances, since the asset value equals the sum of the liability and the equity. One thing to consider is that you can have a negative equity position. I'm sure you have heard of people being upside down in their home or cars where they own more than it is worth. The same can hold true for a business. Now let's look at the most confusing part of accounting. Be sure to review the other resources in this class to help you understand the concept of debits and credits. Most of the time we associate the credit of an account to be an increase entry to the balance of your checking account. This view comes largely from our dealings with our personal banking. We hear the teller say that they are crediting our account when we make a deposit. Keep this in mind as we look at how we use debits and credits in accounting. From the perspective of the bank, your deposit represents a liability to them as they have to pay you back. So from their point of view, they are correct, but from your point of view, it can get confusing. Here are the basic definitions of debits and credits, and this is really all there is to know. Starting with debits, we see that a debit entry increases an asset and decreases liabilities and equity. Credit entries increase liabilities and equity, remember the bank example, and decrease an asset. Here's a chart that summarizes all you need to know about debits and credits. I recommend you print this out or the chart in the resources section of this class and keep it handy as you work through the exercises in the course. Let's take a look at some examples. In this case, we need to record a sale for a business where the customer has purchased something on credit, which will hit your accounts receivable ledger. Since accounts receivable is an asset item, we will need to debit it to increase its balance by the $1,000 sale we made, which will be collected later. The credit entry in this case is a $1,000 credit entry to sales income. Now let's look at what happens when they pay you for this purchase and you collect the receivable owed to you. You will need to record the collection of payment, and this will be accomplished by a debit entry to your cash ledger. Remember that a debit increases an asset account and cash is an asset. You will then need to reduce your accounts receivable ledger by making a credit entry for the $1,000 received. This transaction is now complete and balanced. Here are some examples for you to work out on your own. Use your debits and credits chart and determine the correct credit and debit entries for each transaction. These same questions will be in the online quiz for this course. By taking the quiz, you will be able to check your answers.